Good afternoon, everybody. Welcome to what is now our second BTR Borrowers and Lenders Discussion Forum, kindly hosted by UKAA. Today, we are fortunate in that we're being joined by Jason Hardman, Executive Director of Valuations at CBRE, and Craig Langley, Head of BTR and Student Accommodation Valuation at Savills, both of whom kindly agreed to provide us with their insights into the shifting landscape that COVID-19 is currently presenting to BTR valuation. So today's format is going to be a little bit different from last time in that Jason and Craig are going to share their high-level thoughts on the subject, followed by what will follow by a three-way discussion, at which point I would invite folks to chime in with questions using the Zoom Q&A chat function. So without further ado, Jason, I'm going to go to you first. I thought it might be useful if you wouldn't mind kicking off by taking a minute to just remind us, if you can, what life was like from a valuation standpoint, that is, pre-COVID-19.
Okay, so thank you, Jonathan. Hi, everyone. I guess this is about, I think, my 10th or 11th week working from home. But so going back to when we had lockdown and when offices began to close, which is effectively the middle of March, I think we all had a very positive mindset. And Q1, certainly for 2020, we had witnessed, whether it's the Boris bounce or not, we can't really tell, but really a very positive outlook and framework for the BTR market. I mean, we had, as many of you have seen from our stats, more than £1 billion committed over the quarter, and a higher volume of transactions, or a much higher volume of transactions than in Q4. So certainly the election result in December, and obviously some of the worries about rent controls, etc., had dissipated, and we had a very active and I would call a strong market with, I think, some yield compression, or certainly the prospects of some yield compression, particularly in regional markets outside of London, or prime regional markets. So I'm talking principally about Birmingham, Manchester and Leeds, and that's out of that billion, about 70% was actually deployed in the regions. But we did also have about another £1 billion under offer, which of deals, which some of the deals we expected to go through at the prior to the quarter end. Suffice to say, and I know Craig is going to talk about this, some of that yield compression has dissipated. But I think just turning to the occupational market very quickly is pre-COVID as well. I think all schemes that where rents was had sensibly set rents were letting up extremely well. Strong occupational demand, certainly very good latent demand from a lot of new locations, both in London and I think across some of those prime regional towns and cities. So, I mean, just to be very succinct, a pretty positive outlook as we were going through the rest of the year. Now, obviously, Craig's going to outline what's happened post-COVID.
Thank you, Jason. So just taking that forward, obviously Jason just touched on the volume of investment transactions that we potentially saw happening in Q1 that would naturally be completing over the stages of Q2 and Q3. The vast majority of those deals have been put on hold. Those transactions which I think we've seen effectively stopped or cancelled have been more development focused, because I think naturally there was more concern about those developments being able to, when are they going to be able to get back on site, how are they going to complete. But fundamentally, sitting in the background, we still have a number of these transactions which are ready to go, subject to due diligence and subject to markets getting back to an element of normality. To that extent, we have actually had one completion of a deal that was agreed pre-COVID. You probably saw it in the press last week. So that was a positive indication to where the current market sit. And in terms of any discount, because that's normally the first question that gets asked, from our review, and I think the parties involved, there was no discount to the yield at all. There was an element of suggestion on that deal that the pricing on the rental levels could have moved forward, because we were seeing, as Jason touched on, the kind of the positive Boris bounce that we were seeing in Q1, and rents had started to move forward again, as had capital values. And in addition to that, what we've also seen is two transactions which got marketed since lockdown and have subsequently, both of which have gone under offer. There is still a big due diligence package that needs to be completed, but again, it's been some positive sentiment just to show that really the robustness of the sector. The other key area which we really need to look at and have done a lot of analysis on is occupation. I think much like probably we all experienced when the offices first closed down, there was a lot of uncertainty as to how are we going to operate, how are we going to work. And what we saw was an initial uptick in lots of requests and tenants concerned about occupation, and would they be able to pay rent, would they be leaving? The reality, as we've transitioned through these past kind of 10 to 12 weeks, has been that the vast majority have stayed in occupation. The vast majority are continuing to pay rents. So the vast majority of landlords are reporting rent receipts in the order of 95%, which is absolutely in line with what we saw through previous quarters. So it's really been quite a positive story for what has been quite an uncertain period of time. There are still challenges. In particular, I think unemployment will be the main factor which may impact on the sector as we continue to go forward. And obviously, I think only yesterday we had the latest stats of where that's currently sitting up to April. So that's probably a brief summary. I didn't want to go into too much detail because I'm sure the majority of the questions are going to really dive into that detail. And Jonathan, we're happy to open ourselves up to any questions that you may have.
Thanks, Craig. That was that was useful. I wonder, just picking up on your last point there about the high rent collection rate. Do you, to the extent that the government is effectively subsidising employment via vis-a-vis the furlough scheme, as that starts to burn off in October, do you see that situation changing? Are those people effectively unemployed? They just don't know it yet. And to what extent do you think that'll impact the PRS market?
I think if we'd asked that question probably a couple of weeks ago, I think potentially yes. But I think now that we are getting an element of clarity as to the programme the government is adopting in terms of businesses starting back. So obviously, as of June, we've had a number of businesses open. We've seen the construction sector, pretty much every, because construction went down to something like 11% during the initial, over the course of March. Pretty much now, probably 90% of sites are now back working again. So I think fundamentally there is an element of visibility. So and there is also the key consideration that as individuals, just taking it back to the core of an individual, having a roof over your head is probably at one of the very highest priorities. And that is what we've seen with tenant engagement with build-to-rent landlords, that these tenants, even those that have even been made redundant and are potentially going on to payment plans, they're wanting to pay an element of rent. They want to remain in occupation. And I think that's been, I think one thing that Build to Rent and the corporate landlord has done is actually tenant engagement is far higher. And that has helped to, I think, mitigate, as we currently stand today, the potential challenge we thought might be coming through from an occupational standpoint.
Okay, thanks. So changing lane then, let's address the elephant in the room, that being the material uncertainty clause. that everyone's talking about at the moment, or the MAC as it's known. So it's my understanding that some of the lenders are unprepared to write new loans whilst the valuations continue to include the clause. So my question is, what is it, how does it work, and why is it causing such issues for borrowers and lenders alike?
Okay, do you want me to go for that one?
Yeah, I'll leave you for that nice tricky question, Jason.
Yeah, exactly. Yeah. Cool. Thanks. Okay, so what does it do? I mean, I think a lot of people on the call will probably know sort of the reasons for it. So it appeared in the middle of March pretty quickly as it became apparent there was a huge amount of uncertainty being caused by no COVID-19. It is for use in exceptional circumstances. So we used it after the referendum in 2016. We used it in the global financial crisis way back in 2007 and 2008. So the decision to use it was absolutely not taken. It was not taken lightly, and was done in accordance with the FCA, the RICS, and of course the Bank of England, because as valuers, we fully, we understand the implications that it has to funds and their investors, and also to lenders. What it is there to do is to just recognise the very unusual, uncertain circumstances that exist they existed at that moment in time. In the market, but also to enable us to still value. It is not the case that with this in place we can't value. We absolutely can do. It just happens there is a shortage of more relevant market evidence than we would otherwise expect to be the case. So that is what it's there to do. In terms of in terms of how it and when it gets removed, I think from a residential perspective, as Craig has very eloquently said, the sector is proving itself to be far more robust, certainly from a residential investment perspective, than other forms of real estate in investments. So the expectation would be removed sooner rather than later in comparison with other sectors. However, we will need to see a return to some more normalised trading. Now, more normalised trading from the investment market is probably a dozen or so deals every quarter, maybe not quite necessarily as many as that number. As Craig has alluded to, we're starting to see some deals, but we're probably not quite there yet in terms of exact clarity on pricing, certainly from a yield perspective, and indeed from rents, obviously with the rental market or the lettings market only having recently just been opened up. But I think we are reviewing it on a twice a week with the RICS, and it will be increasingly getting closer to the top of the agenda, I would say, in the near term. But there can be no guarantees other than to reassure everyone that we will remove it as soon as there is some normalised trading in occupational and investment markets.
Craig, anything to add to that?
No, I completely agree. I think the only thing I might add is, from what I was saying previously, had this been a call 3 or 4 weeks ago, occupation was probably a key factor in terms of us assessing and considering uncertainty. I think that is, now that we've got some more market data that's fed through from March, April and parts of May, there does seem to be an element of clarity now as to how they're performing. We've got visibility, some more visibility over costs, this is what's key. It's that data level that is what's key. So I think an element of what would have been feeding into whether the uncertainty clause should still be in place has been removed. You've highlighted though, if unemployment does continue to rise, that could change. But as we stand today, it does seem there is a stable position on occupation. So it's more about the investment trades that we want to see, the activity in the market, the number of bidders actively bidding on an opportunity. We don't want to see 4 opportunities but only 1 bidder per opportunity. It's where we've got a closer to a normalised market.
Do you care to hazard a guess as to when it might be removed?
Ooh,
You can go with that one, Craig.
Thanks very much. So I'm aware that, so I touched upon earlier that we've got 2 transactions that one was by Savills, one was actually by CBRE, that have gone to the market and are now under offer. We are putting to the market another transaction as we speak. I would have probably said it 4 weeks ago, if you said by the end of June, maybe it was a 50-50 as to whether it had been removed, whereas now I think I'd probably suggest perhaps it's 75% chance of being removed in June, by June time, the end of June. But there's still all these kind of unknown factors to really feed through. We've not got, obviously furloughing, and as you touched upon, people that have made redundant is still feeding through. But the positive sign is we are starting to get businesses opening up. There is a kind of a planned structure which should hopefully mitigate some of that. So that would be where I'd stick my neck out to at the moment. But Jason, feel free to contradict me.
No, Craig, I think that's I think that's right. As we've been released from lockdown in terms of the ability to be able to do inspections and therefore due diligence, particularly on the asset that we have under offer in Leeds, and then as you suggested, as other opportunities are marketed and we see the levels of bids, some kind of level of resumption of market activity, given the appetite which clearly remains from an investor perspective in this sector, the anticipation would be that we would see activity coming back pretty quickly. So I think the June scenario is not an unrealistic one, but we absolutely can't guarantee that. But we're reviewing it, and the likes of Craig and I and others who are regularly valuing assets in this space are speaking on a very regular basis, just doing, and that is obviously one of the things which is at the top of the list.
Okay, so some consensus on dates there from the valuation community. Question from Sam Shah from Lloyds. Again, sticking on the MAC theme, is the MAC still applying to assets with an overarching lease with a council or housing association, i.e. individual risk rests on the RP?
So there has been, the RICS website has been updated today with the latest sort of guidance, and everything, all the guidance sort of from is sort of being channeled via the RICS, because it just makes sort of comms, etc. Easier. So that latest guidance is there is some form of long income which is coming out, and so that doesn't at the moment cover affordable housing at this at this stage. From a long income perspective, we have seen some continuation of trading in that market. So that's 30 plus year leases on indexed to RPI at regular reviews, etc. So but not affordable housing per se currently, but that is actively being considered. And you won't be surprised to hear that from what Craig and I have both said, that it's going from the most secure assets to the least secure in terms of order. So logically, the residential investments, whether that's private or affordable, are very much at the low risk end.
Okay. I think if we've kind of done the MAC clause, then we'll kind of go through the gears a little bit here. I mean, one of the things I wanted to, or one of my observations from working in US multifamily, and one of the things that was often remarked is that asset class was, really the last to enter that recession, the GFC that is, and the first to emerge from it. So I'm curious to know, to what extent do you think the UK BTR will mirror that experience, or are the fundamentals of this particular recession so comprehensively different this time that the effect will be to challenge that notion that the BTR is an inherently defensive asset class?
Clearly, this is a very different period we're going through. The levels of what this, if it does turn into a designated recession, will have some influence. I think also we need to remember the UK build-to-rent market is inherently different to the US market. I think many people have tried to put the US market onto the UK, and we naturally have different requirements, a different tenant base, and we don't have, it's very difficult to have the scale of a US build-to-rent model. But I think there are fundamentals of UK housing. We have a housing shortage. We will all, I think it's highly unlikely we'll ever have a supply and demand dynamic whereby supply is outstripping demand, because we haven't built enough houses for so many years. The catch-up requirement is virtually impossible. We have a lack of land. We don't have infinite land to build. So I think the fundamentals of the residential market as a whole are there, which would suggest it will be one of the first to exit. And I think the investment market it's still in its infancy. There's still lots of opportunity. It still represents, build to rent still represents less than 5% of what we call the PRS market. It's still very small in the UK market. So, and lots of funds, a lot of institutions, investors want to get into this market. So for me, I think it's unlikely that we won't follow that trend, but that trend is completely different. We've got a completely different market. We've got a different situation that exists as we currently stand.
Okay. Yeah, I couldn't. So just to kind of echo what Craig is saying, I think that's absolutely right. I mean, so the stats that we have from the multifamily housing market in the US, I mean, clearly it's early days. So the rent collection data is lower. It's probably lower 90s, where everyone seems to be reporting here 94 to 95, generally speaking, for April and May. Obviously, the concerns are post-furlough and high rates of unemployment. However, obviously, in the US market, obviously far more mature, and I mean, they've been at it for 30 years, and they have 160 billion or whatever, US dollars, which trades each year from a capital markets perspective. But there is already some downwards pressure on rents in some locations, but those are locations where there was already sort of increasing supply, and so I think it's just probably accelerated that. So and as Craig said, we don't have the oversupply issues here. Of course, there will be, for one or two locations, some temporary downward impact on rents, I suspect, and on the rental sector as a whole, with people who've got less money in their pocket, and if house prices are falling as well, it's not going to be unimpacted. However, again, as Craig has mentioned, with the professional landlord and being in a managed building, you would expect the BTR sector over here to perform better than the general rental market. But I do think it is going to be difficult for, and we're already seeing it. There are some exceptions, of course. For example, Grainger in their present half-year presentation last week were talking about the rental increases they've achieved. But I do think it's going to be difficult to achieve rental growth over the next period. That's probably the next 12 months. Whether rents go backwards or not will be very scheme and location specific. But I think it's a short-term thing, and we will get back to I think some growth just purely because of the demand and supply dynamics in sort of quick order. But how quick that is, whether that's 12, 18 months or further, it kind of depends upon the broader economic environment and what the government does to sort of help us.
Sure. Yeah. As valuers, then, to what extent are you looking at the income profile of residents in a way that perhaps you weren't pre-crisis? I'm thinking specifically about buildings and communities that have maybe higher levels or higher concentrations of furloughed employees, or perhaps overseas students that are exposed, or maybe tenants that are exposed to the retail and hospitality sectors.
So this has obviously got slightly more challenging with GDPR in terms of the level of data we can actually obtain of tenants. But unquestionably, it's an area where we do look into it because we want to understand. We're constantly looking to understand the demographic of the target tenants who are occupying buildings. How is a building functionally working? So how occupied is it? Are we got commercial being used as pied-à-terre? So therefore, the occupation on a good percentage of units is only 30 to 50% during the week. So it's an area we definitely look at, and I think we have seen some instances of those schemes that have probably been slightly more impacted have been with students, probably less so than what we've seen coming through on furlough, because I think that is more actively being managed, and certainly the feedback I've had from the clients I work with is that individuals that are on furlough are still paying rent. There's only a very few of them that have gone even onto a payment plan currently. The student market is probably the one where we have seen more tenants vacate, but typically students that might be occupying this level of building would probably be dominated more towards the international part of the market, and quite often internationals will be paying 6 months, 12 months in advance. So actually the impact on income isn't nearly as great as what you perhaps would expect. Because obviously we've seen lots of information come out about the student market and about the number of tenants leaving. But if you look at the impact on income, it will be more about the UK-based tenants, less so than the internationals who would have paid up in advance. And I think as we start to get back to an element of normality of markets, then naturally we should then see people able to pay and it being less of an issue. So because of the current data is suggesting in terms of rent collection at 94, 95%, occupation is at similar sorts of levels. Some are still sub 3% even on occupation levels. There just hasn't been the move away from the sector that from the noise we heard in the first couple of weeks that we perhaps thought might happen, because it comes down to the fundamentals that people need somewhere to live. So it is an important factor. It is something we look at, but it's perhaps not had as big as impact as perhaps we first thought. Okay,
that's relief. I'm interested in yields, as is everybody, I suppose. How will this environment impact on the spread between the stabilised and the funding yield? What will funding yields be discounted more now because of perceived greater delivery risk, in your opinion?
Do you want to flip a coin, Craig?
I was just going with the fact we seem to be going one after the other, so I was just going to let you have it. I'm enjoying that you're getting the killer ones.
Yeah, all right. So, okay, so going back to what I was saying, we definitely had some potentially downward pressure on yields in prime regional markets prior to lockdown. That has dissipated. So I think, let's just talk about stabilised assets for the time being. I don't think so rental growth is implicit in yields. So where there has been impact on valuations, it's been more about sort of a short-term impact on income over the next 12 months or so, but not a change to yield. And I think that sort of the outlook, and certainly what Craig was saying, and the deals that are going through thus far, that would appear to be the case, that those are not going to change in the near term. I think for secondary markets and for secondary assets, so older properties, those that don't fulfill ESG requirements for investors, I think those are likely to move out, and I think they probably would have done anyway, but that would it's just going to be accelerated by COVID-19. And you will all have heard the phrase of polarization to prime assets, which happened in the post-global financial crisis, and that will happen in this market for sure. But on the forward, to answer the forward fund aspect, yeah, the risk element from a forward fund perspective for some locations will, and in some markets, will undoubtedly have shifted. So we could potentially see some widening of the gap between, if you like, forward fund and exit yields, or what many of investors are telling us, that they are reworking stacks to not just necessarily to change the overall consideration, but to change the terms of a forward fund, which is complex enough, with even more risk going on the contractor and developer. So that all plays out to the same type of same type of thing, which could have obviously impact on viability in some schemes that are already marginal. But I think again, some of the locations we've talked about, there is such an overwhelming demand and supply imbalance from an occupational perspective that that will keep the balance as existing between if you like the forward fund and the exit yield.
So do you mean geography might override the perceived risk in construction and delivery that would otherwise blow out the yield?
Yeah, no, I think it's going to be very, it's going to be specific, but clearly, if we've seen some investment in some, markets where there is less visibility of what the rents may look like, just purely because there's less of a rental market, or the rental market is less established. And with a political environment, with an uncertain economic environment, over the next year or so, you can be, an investor is less certain about what the asset might actually be worth when it's completed, than would otherwise have been the case sort of pre-COVID-19, where we were, where things were, everyone had a pretty positive outlook, and everything letting up well, and good pretty good prospects for rental growth as well. So just the landscape has just become inherently riskier.
Yeah. One of the things I'm interested in is the kind of the relationship between that house price values and rents. HPI and rents have been moving in lockstep for a number of years now. If the house prices are set to fall, which most indicators suggest that they will do, does that mean the rental sector is likely to benefit via increased demand, or will a weaker economy and higher unemployment simply result in a synchronized kind of rollback in the values of both tenures?
It's an interesting question. So I think because of the nature of the environment we're currently in, and the effect being more on people's incomes, employment, and the fundamental level of debt that the UK economy is taking on, or has already taken on, I think it's more likely that we will see rents follow the trend of house prices, but to a lesser extent, because fundamentally house prices, within that you have got an element of investment, as well as those individuals that are buying for their own needs for their moves. So if just looking at our own forecasts, we're predicting kind of house price movement over the next year to be in the order of somewhere between 5 to 10%. Obviously that's subject to a number of things happening, like Brexit actually getting fully signed off and a proper deal being made. Whereas our rental forecast, I agree with Jason. I think it's unlikely for the next year we're going to see any sort of growth at all in rents, because I think it's going to be from a prospective standpoint, it will be wrong for landlords to be with the way the economy is, the way people are facing all these challenges, to be kind of trying to push forward rents. I think we've already seen some landlords, so I'm aware of one, that for all NHS tenants, they've reduced the rents by 20%. I think there is an element with the professional landlords that it's about, we're still in the infancy where they're still creating brands, they're still creating this sector. And I think there is that an element of corporate responsibility that we're not going to try and aggressively drive forward rents when we've got an economy and a population that's fighting many different things. So I think, of course, unemployment is probably the main factor. We've touched upon it on a couple of points, is going to be the big factor. If unemployment materially accelerates, then I think on all fronts all bets are off. But we still have the supply and demand imbalance. People still need to move. House moves, I know personally from my family, my own parents are moving at the moment. The house purchase, they're still waiting. They've moved and they're renting. I think we will see there'll be an element of that will be going on, whilst people are naturally, we are cautious when we buy. So if people feel that we are potentially going to see a market drop of 5 to 10%, then will people choose, actually, if I need to move, perhaps renting is the right option for the first 12 months. So I think that will continue to create a kind of a positive position on the supply and demand dynamics, whereby we won't see, I think it's unlikely we're going to see rent drops of 5 to 10% at the moment as we currently stand. But I do feel that we will see kind of slightly following that it will fall compared to what I think we've seen before, where it's been kind of almost consistent rental growth. I think that would be kind of the overriding summary. Jason, I don't know if you've got any points you want to add to that at all.
I guess the only thing I would say, and I completely agree, Craig, is that I think it's the right move data that records that in average house prices went down by 18% in post-global financial crisis, but rents only went down by 9%. So if you could broadly say that's half, that's not necessarily what has gone on before, is not necessarily something for the future, and it's a different type of situation that we're in. But at least it points to that it's more robust and defensive, as you've mentioned. And you mentioned, Jonathan, and I think to an extent it depends upon what does the government do to stimulate the housing market, or what it ends up doing, and whether that facilitates more home buying. But the logic is that people are going to have less money in their pocket, and they're going to put off buying for a period, which plays to staying in the rental sector.
Yeah, absolutely. Guys, what sort of special assumptions are you having to make now in evaluations that maybe you weren't doing, say, 3 months ago? I'm thinking specifically about lease up and lease up absorbency over the next 6, 9, 12, 18 months. Presumably less impact in month 24, but for schemes that are kind of coming towards completion and being leased up now. I'm thinking specifically, I mean, one of the areas that banks, credit committees will be interested in is the interest cover and guarantees for that stabilisation period. Are you making any adjustments for that now that you weren't doing before?
Yes, I think that's probably the key area where, and I think Jason touched on it slightly earlier, that is the one area where we are making adjustment to the valuation at the moment. As we currently stand today, we are starting to see tenants now moving back in. We did have what was effectively a 10 to 12 week period where there was no occupation. So if you had a void unit, it couldn't be let. It couldn't be occupied. I think the surprising thing is the number of lettings that actually took place, albeit not completions of those lettings during the lockdown period. And again, this is, I think, the advent of the corporate landlords that has a platform that has CGIs to allow tenants to go on and view properties over the internet. It allows them to sign leases over the internet. There's not the necessity anymore to actually go into an agency office and sign a lease. So we have actually surprisingly seen a solid number of lettings take place. But in terms of from a valuation standpoint, the approach that we've adopted is looking at what we can see as the, generally speaking, on a good day, we thought it might be a 3-month period. I think most felt that potentially up to 6 months you might have an impact. So the approach has been effectively to look at the volume of potentially voids that you might have over that period as a result. So if you've got a scheme which was completing right at the day of lockdown, then obviously we felt you wouldn't have any kind of let up over a period of a minimum of 3 to 6 months. So that effectively needed to be built in and taken off as a capital deduction. And likewise, even on a stabilised building, initially there was the feeling that we would have an element of bad debts, we would have an element of void that would run through natural churn of a building, and that we'd need to make it a capital deduction allowance for that potential loss of income. And generally speaking, each asset is case by case specific, but on a stabilised asset, what I'd be looking at is potentially up to 10% of additional bad debts over that 3 to 6 month period would be allowed for as a capital deduction from the valuation. Which would, in effect, so if you take that 10% over the whole year, it does allow for circa 20 to 40% worth of voids, depending if it's over a 3-month or 6 month period, to actually happen, which is probably, I think, what we're really seeing as a worst case scenario at the moment. And I think that's clearly being represented by the data that's come through in terms of the occupational levels, the level of rent collection, and the level of bad debts. And also on the flip side, we have seen an element of cost savings, because clearly operators haven't got as many staff. A lot of the amenity space is closed. But the flip side to that, we have started to see some rent concessions being offered now for the fact that those facilities aren't available. So we're aware of one operator that's reduced rents by 10% whilst those facilities are closed down. So it's the key area we look at, it's a key area we analyse, and we are making a capital deduction to reflect that potential loss of income.
You've kind of repeatedly mentioned that the collection rates are high, i.e. revenue. Have you noticed or observed any changes to the operating expenses yet, either upwards or downwards, or is it too soon to be spotting trends?
I think, as I touched on, we are seeing a small drop because naturally you can't staff a building properly. It wouldn't be safe. I think most are really operating on a real skeleton level of staffing. So I know one building, for instance, they have one member of staff that goes in 1 day a week to effectively deal with any. And obviously there's immediate like 24-hour call-out facility still to assist from major issues. But generally speaking, they're unoccupied buildings, which is very different to how the buildings would normally be operated. It is about having a level of staffing in there. It is an element of the amenity space. And pretty much every building I'm aware of, the amenity space is closed because that amenity space is about shared communal facilities. So naturally, if you've not got that, there's no need to clean. So those cost savings are probably there, but they're minimal. And it's not, I think, a material factor to really consider as we stand today.
Okay. Jason, maybe a question for you. Are you seeing institutions and funds now looking to shift more risk onto contractors and developers? And if so, do you have a sense yet of how forward funding agreements are likely to be restructured going forward, if that is indeed the case?
Yeah, absolutely. I think I referred to it earlier, but clearly you would expect every investor to be looking at things they've got in the pipe or new opportunities, and aiming to de-risk it as much as is possible. As I said, the risk profile has changed, and I know there's a number of investors on the call, but they're going to want to obviously protect their desired returns and place the risky elements onto whoever they can in the structure. And I think it's as simple as that.
Any examples of how they might do that, or you just don't know yet?
Well, I think there's possibly stretching out some of the payment, some of the payment profiles, perhaps things like the developer or contractor or landowner just participating in some of the performance from a rental perspective. I don't know. I mean, there's various the complexities of a forward funding agreement. There's loads of there's quite a few levers that that a funder could try and pull. And at the end of the day, it's going to come down to the basic market, the basic market dynamics. Because for the best assets, we've still got, as Craig has suggested, good competitive tension.
You guys obviously do a lot of work for the banks. Traditionally or historically, debt has been a little more cautious than equity has in the build-to-rent sector. Banks are a lot more forthcoming. There's more leverage in the space now. Do you see banks retreating going forward, or do you think that the asset class is sufficiently known and favoured now that you're unlikely to see a reversal of that going forward?
I think banks will look at the sector as when we compare it to property as a whole. I think following this crisis, we've certainly probably a positive light, but obviously what we're not naive to the fact is they've got a lot of other things they need to manage out. Only last week I heard that 1 in 7 mortgage owners is on a payment holiday. You've got probably retailers that are financially, there's lots of loans which are going to be quite materially distressed or need to be actively managed, and that requires a lot of work. So it's just how much focus can be put on, I guess, new active lending. But banks are here to make money. It's a way of them to make money, and I think it is seen now as more of towards the safer haven element of the property markets. So generally speaking, there is normally a flight to the safer havens. It's the reason why we've already seen the likes of ground rents, the uncertainty clause removed, long dated income, because they are the safe parts of the market, and they're the parts of the market where everyone feels happy to invest even in the current situation. I think we now have an element of data as well, which was probably the reason why it took banks so long. I think we just didn't have the level of information before to give banks the certainty and clarity around the investment opportunity in terms from a lending perspective. Whereas now we have a lot more visibility on occupational costs. We have a lot more visibility on rents achieved. We have a lot more visibility on how buildings actually operate. And I think now with that data, it gives far greater clarity and understanding to how the asset class works and operates in the UK markets. So I think my feeling would be that it should be positive. We should see more lending, and I think we were seeing that already with the level of rates, competitive rates that were being offered. So I would expect that to continue, because it is being seen as certainly at the more safe haven end of property investment.
Okay. Getting towards the end of our session now, so maybe time for one or two more questions. I'm curious, what does the future direction of travel look like for the valuation community at this time? And to what extent does COVID-19 risk present to the future growth of the BTR sector? Maybe it doesn't. It all sounds relatively robust and positive from what you guys have said, but I'm curious to see if you see any dark clouds on the horizon for those on the call.
Yeah, I mean, I think, so just going back to the part of the previous question, I mean, for sure, a lot of the banks have been sort of internally focused and concentrating on rent collection from sort of interest payments, in April, and I think they've got some not challenges, but there obviously some risks around July interest payments when June quarter rent comes in or doesn't come in from particularly commercial related sectors. So there has been a kind of not quite embargo, but a reduction in the number of sort of new terms that have been put out there. But I think once we get back to, and I'm sorry to use this kind of word, some kind of normality, which is kind of beginning to happen, then I think this should be renewed, as Craig said. There's no reason why there shouldn't be renewed appetite and increased appetite to provide debt into the resi investment market. I think it's kind of like what's on the horizon. I think it's kind of we mentioned some of those things before. I think clearly monitoring how occupation and rent levels, both in terms of rent collection and actually in the sort of what the net effective rents are, because I think we might see increased use of incentives to either help people to stay or for new lettings in the short term. So I think, and the interpretation of that in sort of the overall market evidence, I think is something that we've got to be very careful about, particularly as people come out of furlough or we start to have higher levels of in employment possibly in the autumn. And I think also coming back to some opportunities just aren't going to get off the ground because some of the viability is going to be impaired because of some of the inability to be able to get structures structures right from a development, from a development perspective. Perhaps finance will be more cautious as in the near term as well. So that might that's probably going to impact on supply, and of course we've had delays. That's going to put some launches back from this year to next year. I'm sure some investors and developers will want to try and catch up as quickly as they can. So for sure we're not going to see the growth that we were hoping to have seen at the start of the year, and that we've seen through through Q1. But I think as valuers, it's just it's the likes of us and Savills and others just in ensuring that we're being consistent in terms and that the evidence is shared, so that so that we can try and make the market as be as clear as kind of the direction of travel of the market as is possible, really. Thanks.
Craig, a couple of minutes left. Any want to indulge in any future gazing or?
I think Jason's said the vast majority, and I think the only thing we obviously touched on that we speak regularly. We do that as a group of pretty much all the major firms to do just that, share information, because I think information is key, and that will hopefully give more certainty behind. You touched on about what special assumptions we had in previous valuations. The more information we have, the less assumptions that need to be made. So I think that's something, the collaboration that we've been able to have in terms of the willingness to share information, to work together, has been very good, and I think that will continue, because it's important. We need to make sure that we're providing banks and clients with the right standard and level of information, and I think that will help support the sector to come out in a positive standpoint.
Okay, all right. I think we're probably going to draw stumps now, guys. So I'd just like to say thank you to Jason and Craig for sharing your time and your valuable insights today, and also to everyone who contributed with really kind of interesting and useful questions. Just before we go, I just want to remind everyone, if you are finding these sessions useful, UKAA are happy to continue hosting them, but I would ask you to lob in suggestions for topics if you've got any burning issues, and to direct those to Dave Butler at UKAA, and then we can pick those up and try and evolve them going forward. So thanks everybody, enjoy the rest of your day, and let's do this again soon. Bye.
Thanks very much.